Hey, good morning. This is Mayor Valensky with Driving Markets. The usual caveat is you all know it by heart by now. You all know it by heart. I've had many viewers have called me up and repeated it, but let's go over it again. Anything said in this piece is an opinion only. It's purely for media broadcast to give you a little bit of knowledge. Anything that you make in terms of your financial account, trading account, is great. It's yours. Anything you lose, what can I do? It's painful, but there will be losses. Anyhow, let's move on. So John Williams, the head of the New York Fed, was interviewed yesterday, and he stated clearly that interest rates are only going to go up higher. In fact, he thinks they're going to go much higher. Simply because they haven't got inflation under control, and the chance of getting inflation under control short term is going to be really far-fetched. It's got more chance of Dracula donating to the blood bank than you have of inflation coming down in the near future. What he stated is that the central banks have got focused on getting inflation down to the 2% region, and he actually sees interest rates going up in 2023. Now, I've been saying this for a while. I've been saying that interest rates are not going to stop and are not going to go down. So the investors and the bankers and the traders and all the analysts and the hedge funds are living in cloud cuckoo land, living in fantasy land, that they honestly believe that the interest rate cycle has come to an end in 2022 on 2023. So I'm calling it here on Driving Markets specifically that rates are going to go up, and what we're looking at next year is we're probably looking at interest rates at around about the 6-7% level. Sounds a bit far-fetched, sounds a bit wild. I know it sounds painful, but inflation is going to be running at around about the 18% level in 2023. In fact, I called it July 2023. I said inflation is going to run around about the 18% level, and that's having a big impact on markets. So what you've seen yesterday is you saw financial markets were very whippy, came down, fell off, and all the high-risk assets like Bitcoin and shares in the Nasdaq fell away. So I want to focus a little bit on the Nasdaq and a couple of major components there. The ones that I see at most risk in the Nasdaq is Facebook, or Meta as they call it, and Apple. Apple is a sell at 162. It's a sell, and Apple itself is like 12.5% of the Nasdaq, and it's just too high. I can see it floating all the way back to the 106 level, and therefore, especially as rates go up, and rates will go up, then shares like Apple and especially Facebook will be affected. Talking about Facebook, I'm calling Facebook around about the $100 a share level. It's just going nowhere. It's totally reliant on advertising revenue, and as we will soon see, the economies are in reality going into recession, and that's going to infect the advertising budget of corporates, and Facebook is fighting in a tight market space for advertising revenue, and it's just not going to make it, and its corporate earnings are going to fall short of analysts' expectations, and I expect the share there to fall down around about $100 a share. But one of my colleagues who I speak to regularly said that Apple is probably a better bet to short than Facebook. Well, actually, I'm calling both of them a short, so just take that into account. Also, you've got, as far as foreign exchange is concerned, you've got the US dollar, which is on a high, came off slightly yesterday, but I'm still a big buyer of the dollar yen. I think it's going to breach the 140, go to 142, and the pound came off against the dollar because simply the pound politically, or the UK politically, is not stable, and also some very negative comments by Andrew Bailey, that absolutely useless head of the Bank of England, or the head of the Bank of England and head of the MPC. He's actually got a terrible history, and it's just a job for the boys, and therefore he got another job at the Bank of England, which really he should be fired and probably packing shelves at Tesco's. Anyhow, that's a side point. Him with Joe Biden, by the way, and Kamala Harris, all of them should be packing shelves at Tesco's or Walmart, whichever country they're in, because that's all they're capable of. Anyhow, going back to financial markets, Bitcoin dropped below the 20,000 level yesterday, and today is bounced up overnight to 20,300, but still seeing Bitcoin as a sell short term. It's going going to test the 17,700 low level back all the way back in June, and if it touches that, then it could test the next level down, which is 15,000 on Bitcoin. Take that into account. Going forward, you've got the non-farm payrolls on Friday. Very interesting. Now, if a number comes out better than expected, they're expecting around about the 293,000 new jobs created. As long as new jobs are going to be created and the number is equal to or greater than what's expected, then you're going to have more pressure on the Fed and on the banks to raise interest rates. Why is that? Because full employment will mean higher demand for goods, consumables, and that will just push inflation even higher, and therefore will be a bad sign. So if the number comes in greater than 293,000, then you're going to have the markets probably being sold off again on inflation concerns. Just take that into account. You've got Eurozone inflation on Thursday, which is CPI, Consumer Price Index, and you've got the PPI on Friday in the Eurozone. That'll have a big impact on the euro. Again, the euro dollar is a sell, even though it's above par at the moment. It's to 10 something, like 10,003, tiny amount above par. It's going to be sold off, and it's going to test the 95, 96 level, which was the low in the past. Okay, so keep an eye on that. That's more or less it. All came off yesterday due to output fears and recession fears, but I still see it as a buy. All right, that's it for the moment. This is Meir Walensky with Driving Markets. Have a good day. Hope you're enjoying the reels, and speak to you soon. Have a good day.